Everyone tells you to diversify your portfolio. Financial advisors say it. Articles repeat it. It shows up in almost every investing book you've ever read. But here's the problem. Most investors still don't actually understand how diversification protects them, or when it doesn't. Because diversification isn't about owning more stuff. It's about reducing investment risk, controlling volatility, and protecting your money when markets don't behave the way you expect. In this video, I'm going to show you what diversification really is, why most people misunderstand portfolio diversification, and how it actually works in real life, not just as a buzzword that sounds smart. Before we dive in, make sure to hit that subscribe button. I post new life plus money videos every week to help you invest smarter, manage risk, and build long-term wealth without hype or fear. By the end of this video, you'll understand how diversification actually works, how asset allocation protects you during different market cycles, and why building a balanced portfolio matters far more than chasing the highest return. Let's break it down. Why diversification is so often misunderstood. Most people think diversification means owning a lot of investments. If I own enough stocks, I'm diversified. It sounds logical. It feels responsible. But it's completely wrong. You can own 15 different stocks and still be taking enormous risk if those stocks all move the same way during a market downturn. True investment diversification has nothing to do with how many holdings you own. It has everything to do with how those assets behave together. If everything in your portfolio rises and falls at the same time, you're not diversified, you're concentrated. And this is where many investors get trapped. They think they're spreading risk, but they're actually multiplying it. Real diversification is about combining assets that respond differently to economic conditions, interest rates, inflation, and investor behavior. This is the foundation of risk management investing. The goal isn't to win every year. The goal is to avoid catastrophic losses so you can stay invested long enough for compounding to do its job. The real risk most investors face. Here's something most people never hear. The biggest risk most investors face isn't picking the wrong stock. It's emotional investing. Markets don't just move numbers. They move people. When markets rise, greed takes over. Confidence turns into overconfidence. Risk feels invisible. When markets fall, fear takes over. Logic disappears. Long-term plans get abandoned. This cycle leads people to do the exact opposite of what works. They buy after prices have already gone up, they sell during market crashes, they abandon their investment strategy at the worst possible moment. And here's the hard truth. Most long-term underperformance comes from behavior, not from bad investments. A properly diversified portfolio reduces emotional decision-making because it reduces volatility in investing. When your portfolio isn't swinging wildly, you're far more likely to stay calm. And when you stay calm, you stay consistent. Consistency is the real secret behind long-term investing success. Diversification doesn't just protect your money. It protects you from yourself. How diversification actually protects you? Diversification protects you in three very real, very practical ways. First, it smooths volatility. Different assets respond differently to economic conditions. When one area struggles, another may remain stable or even grow. This doesn't eliminate losses, but it reduces how extreme those losses feel. Second, it provides downside protection. No one can predict market timing. No one knows when recessions, crashes, or sudden shifts will occur. Diversification limits how much damage any single event can cause to your overall portfolio. Third, it keeps you invested. This might be the most important benefit of all. A calmer portfolio leads to better decisions. Better decisions lead to better outcomes. And better outcomes compound over decades. This is why asset allocation matters more than individual stock picks. Asset allocation explained: simply think of asset allocation as the structural design of your portfolio. It's not about finding the best investment. It's about combining investments that play different roles. Most diversified portfolios include a mix of stocks and bonds, index funds, ETFs, real estate investing, and sometimes alternative investments. Each asset class exists for a reason. Stocks are there for growth. Bonds provide stability and income. Real estate can offer cash flow and inflation protection. Index funds and ETFs deliver broad market exposure with lower costs and less complexity. A balanced portfolio isn't built to predict the future. It's built to survive uncertainty. That's the real purpose of diversification. Let me pause you right here for a second. If your portfolio dropped 25% tomorrow, would you panic? Would you feel the urge to sell? Would you start questioning your entire plan? If the honest answer is yes, then the issue isn't your returns, it's your risk exposure. This is exactly why diversification matters. Not because it sounds responsible, but because it keeps you invested when emotions are screaming at you to do the wrong thing. Okay, let's keep going. Common diversification mistakes. This is where a lot of well-intentioned investors get tripped up. They believe they're diversified, but they're not. Owning multiple tech stocks isn't diversification. Owning multiple growth stocks isn't diversification. Owning funds that all track the same underlying assets isn't diversification. Another common mistake is ignoring correlation. If your investments move together during stress, they're not reducing risk, they're amplifying it. These mistakes quietly increase investment risk, even when people believe they're being conservative. Real diversification requires intention. It requires understanding how assets interact, not just how they performed last year. What happens during market crashes? A lot of critics say diversification fails during market crashes. That's only half true. During major market crashes, correlations often rise temporarily. Assets move together more than usual because fear dominates everything. But here's what diversification actually does in those moments. It limits damage. It preserves capital. It reduces the chance of permanent loss. The goal was never to avoid losses entirely. That's impossible. The real goal of diversification is survival. Survive the downturn so you're still around for the recovery. That's the difference between speculation and true financial planning. If this breakdown is helping you understand investing more clearly, take a moment to hit subscribe. This channel is about building wealth through clarity, patience, and smart risk management, not hype or shortcuts. Diversification versus performance. Chasing a diversified portfolio will rarely be the top performer in any given year. And that frustrates a lot of people. They see headlines. They see social media posts. They see someone bragging about massive returns. But here's what rarely gets talked about. Those same portfolios often experience massive drawdowns, emotional stress, and inconsistent results. Diversification trades excitement for reliability. Over time, that reliability dramatically increases your odds of wealth building and financial independence. This is why passive investing works so well. It's not flashy, it's effective. Boring works. Discipline works. Staying invested works. Trying to outsmart the market usually doesn't. How to apply this in real life? You don't need complexity to diversify properly. Start simple. Use broad index funds and ETFs. Choose a logical asset allocation based on your risk tolerance. Invest consistently, rebalance occasionally, not constantly. Avoid the temptation to tinker every time markets move. The best portfolios are built with patience, not prediction. Diversification works best when you let it do its job quietly in the background. Diversification isn't a buzzword. It's a system. A system for managing risk. A system for controlling emotions. A system for staying invested. A system for building wealth over decades. It won't make you rich overnight, but it will dramatically reduce the chances that you sabotage your long-term success. And that's how diversification actually protects you from investment risk. If you want more videos like this, clear, honest explanations about investing, risk, and money, make sure to hit subscribe. And if this helped you rethink diversification, share it with someone who still believes it just means owning more stocks. Thanks for watching. I'll see you in the next one.